Hey team, Accounting Fundamentals, and we are taking a journey where we're exploring revenue, costs, and profit, and asking the question, well, who is holding the rope tied to costs in our business? So our accounting cycle continues, right? We're making great progress here, and we're coming up to a next important step. We're not quite there just yet, but this is the last bit of groundwork that sets us up for preparing the financial statements. When we say financial statements, plural, there's four main financial statements. We're going to get there, but first we're understanding revenue, profit, and costs, and what does that all mean in relation to those important financial statements? We can look at our journey like this, where we've been narrowing and funneling down. And we started off at analyzing transactions, and we made journal entries and T accounts. We took that information into the general ledger. We created a trial balance, and then we ultimately created an adjusted trial balance after adjustments, depreciation, and so on had been made. And that's where we left off. But the point here is we're funneling. We're making our way down to get closer and accurate and more detailed information. That's the information we need to create financial statements. So all the way down here, adjusted trial balance, done. Next step, let's go. So to explore revenue and profits, it's easy to think, well, hey, all this money coming into a business equals a whole lot of profit. Yeah, not so much. There's a lot that has to happen. There's a lot that has to be taken away from revenue to get to, hopefully, fingers crossed, some profit left over at the end. Let's explore those revenues and profits and how that all works. So the question here is really, what is revenue and what is profit? And let's think of it in terms of a bag of money. On the far left, we've got a bag of revenue, and you can see that there's some shrinking, there's some scaling down that goes on. Now, there's all sorts of information and reading in the class packet that supports the idea of revenue and profit, because when we talk about profit, there's lots of different pieces of terminology related to different size pots of money, different size bags of money that's all related to profit. So to look at revenue, think of revenue as, it's money coming in, right? It's the watering can that is growing our business. That money that comes in helps our business grow. Think of revenue, think of that watering can. I'm going to continue that analogy. I think it's a powerful picture to visualize. So when we look at revenue, if revenue is the money that comes into a business as a result of either selling products or providing services or doing both, revenue is the money that comes into a business. And think of the watering cans. Revenue, this business could sell a lot of individual products and have a lot of different watering cans adding revenue in. Think of Luca's Lemonade. We're selling beverages. We could be selling merchandise. We could be selling catering. We've got all these different revenue streams that are coming in. And also a business could be providing a lot of individual services. So we could have individual watering cans coming in related to the services that we're providing. Revenue is the watering can. It's what's keeping our business going. Now, revenue, this dollar value of revenue sources, these different ways that revenue comes into the business. When we present financial statements, the revenue sources could be presented as one single combined figure. We could have all the different watering cans and roll it up into one giant watering can that we present in the financial statements as one single figure, or the dollar value of revenue sources could on the financial statements be presented as separate individual line items. And sometimes it's done one way and sometimes it's done the other way. Obviously, if you have the separate individual line items referenced in the financial statements, it gives you an ability to be able to isolate each of those different line items and see where the greatest revenue or the least revenue is coming from. And that could be an important element as well. No right way, no wrong way, depending on the information that you're trying to gather. Just keep that thought of how you represent those watering cans. Just keep that thought in mind. Now, to turn our attention to profit, because there's lots of different terms related to profit. Now, what is it? Well, it's not a simple answer. We need to unpack each of the individual terms and each of the individual labels related to profit. On the very far left-hand side, we've got revenue. Now we're starting to think about these other terms. I'm going to mention gross profit, operating profit, and net profit. gross profit, operating profit, net profit. Or we could just simplify it and call it gross, operating, and net. Now, starting at gross profit. So gross profit is the profit a company or a business makes after we deduct the costs of making and selling products. What are we deducting them from? We're deducting them from revenue. So revenue is our biggest bag of money. So gross profit is the profit a company or business makes after deducting the costs of making and selling those products, or after deducting the costs of providing the services that the business provides. Think of think of a lemonade stand, like a neighborhood lemonade stand, and you got a kid selling lemonade on the corner, and the kid makes the revenue of $1 for a glass of a cup of lemonade, and after we deduct the costs of making that lemonade, that kid's got to pay for a cup. That kid's got to pay for sugar and for lemons, and that kid's got to pay for ice, and that kid's got to pay for a lid, and that kid's got to pay for a straw. So all the $1 that the kid made selling the lemonade is not profit. We've got to take away the costs of making that product. That's called gross profit. So the cost of making and selling products in its official term is called the cost of goods sold. What did it cost us to make those goods? So cost of goods sold is the cost of making and selling products. That's the dollar value that we got to determine and take that away from revenue to come up with this terminology called gross profit. Now, cost of goods sold, it's a really important term that threads itself all the way through the remainder of the financial cycle. It gets a little abbreviation, a little acronym called COGS, C-O-G-S, COGS. So you'll see reference and hear reference to COGS. COGS is the cost of goods sold. It's the cost of the cup and the straw and the lemonade and the sugar and all those things that kid needed to be able to sell that dollar's worth of, generate that dollar's worth of revenue selling their lemonade on a street corner. Now, an important term, this cost of goods sold, it's embedded and supported in the reading in the class packet. Really need to get after that information, read it to support what's going on here. So costs of goods sold. Costs of goods sold, the term sold means sold is done. It's already happened. Costs of goods sold. What did it cost us to sell what's already happened, right? So there's some different cost of goods sold ways, some different costs of goods sold methods, different ways to get to determining that. And later on in the course, we're going to unpack something called cost flow assumptions, which is you just make an assumption that everything happens in this regular, same, consistent way. Those different cost flow assumptions have some little abbreviations to go with them called LIFO, FIFO, and WAVCO. We're going to unpack those later. But right now, at this point, in terms of cost of goods sold, we're looking at something called the inventory count of wall-to-wall, a wall-to-wall inventory count. And we're going to use a wall-to-wall inventory count to help us figure out the cost of the products that we use to be able to generate our revenue. So we're focusing here on wall-to-wall inventory count. So costs of goods sold. We're using wall-to-wall inventory count to generate costs of goods sold. I'm going to give you a little bit of some language and terminology, then we're going to unpack what actually a wall-to-wall inventory is. So cost of goods sold, we need to generate and understand what our beginning inventory of product is, and we need to understand what additional purchases we made, and then we need to subtract an ending inventory to be able to come up with this figure called cost of goods sold. Now, this happens, let's say we're at the end of a month, we're closing out a financial period, or at the end of a quarter, which is 3 consecutive months, and we're closing out a financial period. We would need to know at the beginning of that month that we're just closing out, or the beginning of that quarter that we're just closing out, what was the beginning inventory of product at that point in time? And then we would know what additional purchases were made during that month or during that quarter. And at the very end of the quarter, or that month, we'd need to know what our ending inventory is. And from there, we can figure out this thing called costs of goods sold. Okay, costs of goods sold, or COGS, which is a really important number. We need it to figure out, we're looking at profit, our gross profit. So let's say let's put some numbers in there, because numbers kind of really make this theory make a whole lot more sense. Beginning inventory was $800, and during that period, let's call it a month. We're standing at the end of the month looking backwards into that month. The beginning inventory at the beginning of that month was $800. During that month, we had $2,400 of invoice activity. right? From receiving all our different product. And at the end of that month, we figure out that we have $600 value of inventory. Then we take 800 plus 2,400 gets us a dollar value of 3,200 minus 600 would mean that our cost of goods sold for that period was $2,600. Okay, now what do we do with that? How do we get to this? So how are those numbers generated? Well, that's where this concept of a wall-to-wall inventory comes in. So wall-to-wall inventory, and what does that reference imply? Well, you literally start at one wall in a storeroom and you count every single thing that you have in that storeroom until you get all the way across to the other end or the other wall of that storeroom. That kind of sounds like a tedious task. It is. Wall-to-wall inventory. The term implies we start at one wall, we count everything that we encounter from till we get to the other wall. There's a lot of work involved in generating this wall-to-wall inventory, but it's really, really important. So this wall-to-wall inventory, it calculates the total dollar value of all our existing inventory. So imagine a software system or a spreadsheet. Simple spreadsheet could work for a small business, software system or inventory management system for a bigger business, please. So we calculate, so we have to count everything, and then we take our inventory count, those numbers, put it into our inventory management system, put it into a database management system, put it into a spreadsheet, and we have match those item counts with the actual item listed in the inventory management system and the cost to generate that it took to buy that product. And then that cost for the product times the number of items that we have tells us the dollar value, total dollar value of that product. And the point is, everything gets counted. Literally everything has to get counted, measured, or weighed. And that takes a lot of work. It takes a lot of time, energy, and effort. And it's going to be boring. And you can't skimp on it. You can't skip. You can't take shortcuts. You've got to get it right because this flows into financial statements. And that's a really important part of the business. So figuring out this or evaluating this cost of inventory, where everything gets counted, is a fundamental part of this revenue minus the cost to generate that revenue to end up in the first profit bag of money, which is called gross profit. Why do we count it? Well, it's obvious. We count it by doing this wall-to-wall full inventory to determine the costs of goods sold. Now, think of a waterfall, this picture of a waterfall. This cost of goods sold, this waterfall process of flowing, the waterfall is flowing information, flowing dollar values. It starts in a storeroom, right? And the flow ends up in financial statements. The financial statements are a really important part of the business. This really important part of the business, called a financial statement, starts in the storeroom where you do a wall-to-wall inventory. That wall-to-wall inventory is tedious, it's boring, but it's really, really important, and it's got to get done. And it's got to get done accurately. Because the next steps is the next steps in this accounting process is these financial statements. And there's an S. And I've highlighted the S. There's multiple financial statements. There's 4 of them. I'm going to show you one here, which is called an income statement. I'm going to use this income statement because it shows you where this cost of goods sold goes. So if our next step in the journey is preparing financial statements, here's a sample of what's called an abbreviated income statement. It's a very short, brief one, doesn't include all the information. And you can see that in this financial statement, this called an income statement, which is the name of one specific financial statement. It says there's a sales line, and then there's a cost of food sold line and gross profit. We're talking about gross profit. Now, what is the cost of goods sold, right? Let me take this back. This cost of goods sold, costs of food sold, right? Cost of goods, cost of food is talking about the exact same thing. Cost of food sold, cost of goods sold is the very first line item that's subtracted from sales. Sales is revenue. So sales revenue of $1,450,000. The very first thing we do is we subtract the cost to generate those sales, in this case, $493,000. Then the gross profit is $957,000. Not to be confused with profit all the way down the bottom, because $957,000 is a lot different to $113,500. Profit has lots of different parts. There's different parts to it. Costs of food sold, costs of goods sold, that's our important stopping point right now to get to gross profit. So we're talking about profit. Now, gross profit is the profit a company makes after deducting the costs of making and selling products. That's cost of goods sold. We just explored that. Or after deducting the costs of providing its services. That was gross profit. It has brought us back full circle because we took a little sidestep looking at costs of goods sold, and now we're coming back to the gross profit bag of money. So to summarize gross profit, it's what's left after paying to generate the goods or services. Gross profit. Now, there's still lots of additional expenses that need to be deducted from gross profit. So we need to go back to the money bags and figure out what's our next step. So here's our money bags. We had revenue that came in, gross profit, which shrinks down after we take away that costs of goods sold. Gross profit represents the biggest of the three profit bags, with the fourth bag on the left being revenue. Gross profit is the biggest of the pot. We got to shrink it a lot. There's a lot of expenses that need to come out yet. So operating profit, which is our next stopping point, our next size down bag of money, operating profit shows what's left after paying operating expenses. Well, what's operating expenses? Operating expenses are the expenses that need to be made in a business in order to do business. If we weren't doing business, we wouldn't have operating expenses. Operating expenses are the costs, the expenses that are involved in doing business. Operating expenses, there's a lot of them. It's things like salaries and wages, rent, the payment of rent, the payment of utilities, where we wouldn't be using electricity and gas if we weren't doing business. It's the payment of the phone line to support the business, the internet service that supports the business. If we weren't doing business, we wouldn't have to pay salaries or wages. If we weren't doing business, we wouldn't have to pay rent or utilities or phone or internet service. Operating profit is what's left over after we pay for all these costs. So if we go back to this sample abbreviated income statement, just a mini version of it, we had sales, we took away costs of goods sold, cost of food sold, cost of goods sold, same thing. We ended up at gross profit. Now we've got all these different expenses that are involved in doing business that need to be taken out and away from that previous line of gross profit to end up at what we're going to call operating profit. Now, if we're talking about expenses is an E under DC Adler, under our DC Adler grid. So we're going to go back and revisit DC Adler for a minute. So debits on the left, credits on the right. Assets draw expenses under debit. Expenses live under debit. So we need to understand and unpack a little bit about expenses in the DC Adler construct to be able to figure out where we're going with these expenses. So let's go. So if we understand the different expenses, if we can understand how different expenses work, that's a starting point for understanding the financial statements that we're going to be generating shortly. And so understanding expenses helps us build financial statements, and fundamentally, it helps us understand what's in those financial statements. So we're taking a little sidestep and we're looking at costs and expenses. Costs, expenses, kind of same. We're looking at those, unpacking some different types of costs. And you can see here on the left, it talks about all those signs are talking about fixed costs. On the right-hand side, there's a little call out to something called controllable versus uncontrollable costs. So we're unpacking costs. So controllable and uncontrollable. So on the screen, it says non-controllable and controllable. That's our cost categories. Non-controllable costs, an example is fixed, means a fixed cost is something that you can't control. It stays fixed. The dollar value stays the same. Now, you can control whether you make the decision to start that cost, that fixed cost, but once you start it, it's fixed, it stays the same. Under controllable, we have what's called variable and semi-variable costs. And there's more information and reading in the class packet that helps understand and explore variable and semi-variable costs. But we're going to go there. We're going to take a look. So we've got non-controllable fixed costs, and we've got controllable variable and semi-variable costs. So under the fixed costs, this image that's included, fixed costs, always occur regardless of production, regardless of how busy we are. If we're thinking about a restaurant, we have fixed costs, and the fixed cost example of rent, we pay the exact same amount of rent whether our business is humming along and full, or whether the seats are empty. We pay rent, it's fixed, it stays the same. Pay rent on an apartment, it's fixed, it stays the same. You don't get to negotiate with your landlord to pay less rent when you have less income during a month, it stays the same. Variable costs in the middle increase with the amount of production. So the busier we are in a business, then the greater our variable costs are. They go up at the same time. An example of variable costs is food cost. The busier we are in a restaurant, as an example, the more food we got to buy. So our food cost, the cost of food will increase, variable costs increase or decrease with the amount of production. If our business levels go down, our expenses of variable costs would also go down. And semi-variable costs on the far right, it has a flat fixed cost element to it, but it also increases with production or also decreases with production. An example of semi-variable cost is labor, right? Our fixed flat component of labor is going to be management's costs, because we're paying management salaries regardless how busy or quiet a business is. But the hourly labor is a variable cost. We use more hourly labor the busier we are. We use less hourly labor the less busy we are. So semi-variable costs is a mashup of some fixed and some variable costs that roll in together. And a great example is labor. Management labor, fixed. Hourly labor is variable. So type of costs, we got non-controllable fixed costs, and we got controllable variable or semi-variable costs. And the point of this is these costs are really important, because we're going to take away all these costs from our gross profit. So we're understanding costs. So non-controllable costs, fixed costs like rent or insurance, your insurance costs in a business stays the same. Licensing fees, they stay the same. Loan or interest payments, right? They stay the same. Granted, if the loan payment percentage changes, the bank changes their percentage, then that percentage dollar value might change, but the fact that we still have to pay that loan doesn't change. And controllable variable and semi-variable costs, examples, labor and food costs. Utilities, we're going to use more gas the busier we are. We're going to use more electricity the busier we are. We're going to use marketing is a controllable cost. We're looking at controllable. The category is controllable or non-controllable, right? Labor is controllable. Food costs is controllable. Utilities, marketing, administrative costs, they're all controllable. And controllable costs are the ones that we can control. So when we're taking money away from gross profit, it's going to be our controllable costs that we're looking at to see where we can trim up and save and stop the expenses getting out of hand. So I'm going to show you back to this financial statement, this income statement, which is one of the four main financial statements. And the question is, when we look at this financial income statement, what are the two greatest cost lines in this statement? So here's the income statement. Again, it's an abbreviated, simplified one. What are the two greatest cost lines? Well, the first greatest cost line is the cost of food sold, cost of goods sold, the cost to generate our revenue. And the second greatest cost line is labor. So food and labor are typically in a food service business are going to be the two biggest cost line items. And if they're the two biggest cost line items, they need some special attention. So these two biggest cost line items enter the term of prime cost. Prime cost is costs of goods sold and labor costs together, the two biggest cost line items in a food and beverage business. Cost of goods sold and labor cost. And the number of 65% is going to be a key figure. We're talking about prime cost. Prime cost is the cost of goods sold plus labor costs together. Cost of goods sold plus labor cost equals prime cost. It's so important it gets its own name. It's called prime cost. An accurate prime cost depends on accurate inventory. If we're going to know what our prime cost is, the cost of our food and labor, then our cost of food, cost of goods sold, that is embedded in inventory. So we're going to need to know our inventory to represent cost of goods sold, and cost of goods sold is 50%. It's half of the important main cost element of prime cost, the other half being labor. So that comes back to the importance of that accuracy when we generate that cost of goods sold. Cost of goods sold plus labor is prime cost. And it always goes all the way back here to this wall-to-wall inventory. It all is embedded and tangled up together. All of this is tied together. Now, there were some cost flow assumptions I mentioned that we're going to unpack later in the course. The FIFO, LIFO, and WAVCO, we're not there. We're going to unpack that later. All of this cost of goods sold is coming from this idea of wall-to-wall inventory. So prime costs, which is food and labor, food is a picture on the left, labor is a picture on the right. And in a restaurant and food and beverage prime cost, how to calculate it is really important. So prime cost, which is costs of goods sold and labor costs. And if we're in a food and beverage environment, our cost of goods sold is going to be the cost of our food and the cost of our beverage to generate sales. Cost of goods sold, labor cost equals prime cost. So food cost is variable. So we're pulling in this terminology between variable and semi-variable and fixed and controllable and non-controllable. Food cost is a variable cost. Now, food cost as a variable cost, meaning variable cost is going to go up and down. If we're busier or quieter, food cost is going to go up and down. So the amount of food purchased during a busy or quiet trading period is going to be proportional to sales. It's going to vary. It's going to go up and it's going to go down. So food cost is a variable cost. That's important to know. If it's a variable cost and it's also controllable cost, that's really important to know because we can control it. Now, labor is a semi-variable cost because we've got a mix-up of management labor and hourly labor. So hourly labor, so labor is semi-variable. Hourly labor, the amount of hourly labor utilized in busy or quiet periods should be proportional to sales. Why does an hourly labor person get cut on a slow night in hospitality service? Because it's a controllable cost. When hourly labor gets cut, then the management that cuts the hourly labor is controlling their labor cost. So labor is a semi-variable cost. When we look at management labor, that the manager doesn't get cut and sent home early on a quiet night because their labor is a fixed cost, meaning the business has got to pay for that management labor no matter how busy or how quiet it is. Labor is a semi-variable cost. So the variable cost of hourly labor plus the fixed cost of management labor is a semi-variable cost together. And we're talking about labor because we're talking about prime cost. Prime costs, cost of goods sold, and labor costs, and understanding how variable and semi-variable and controllable and uncontrollable all fit in together to this equation of costs, specifically prime cost, cost of goods sold, which is controllable, and labor cost, which is controllable, meaning we're to control it. When we get to control it, we're holding on to the rope related to costs. Now, this 65% figure that's in the middle of the Venn diagram here. So prime cost should typically, prime cost, the cost of food and cost of labor together, typically should not exceed 65% of all the costs that we've got to pay. We're going to pay a lot of costs. 65% of those costs should not get consumed, used, allocated beyond food and labor. Now let's put it into a visual here. So if the pizza represents, the whole pizza pie represents our total revenue in the business. Revenue is our watering can. The circle of the pizza is the whole revenue. Let's look at it this way. We got to divide that pizza up and feed it to all these different expenses. So on the right-hand side, if the cost of goods sold that's a big chunk of pizza. right? Cost of goods sold, let's say it was 30%. And down the bottom corner, another big chunk of pizza of labor cost is 60%. Now, if we're trying to be below 65% in combined food and labor, in this image, we succeeded. We are below 65%, 30% plus 30%. Now we've still got to pay all these other costs. We're going to pay for our controllable expenses. Let's say they chewed up 10% of the pizza, and utility costs, right? The cost to occupy the business, the cost to turn on the electricity, and we're going to pay administrative costs, right? The cost of doing the business from an administrative perspective. Let's say that was 5%. That gets a 5% of the pizza pie, and we're going to pay interest, and we're going to pay maintenance, and we're going to pay some other miscellaneous costs. Oh my gosh. We hope to have some profit. Look at the size of the pizza pie, the slice that profit's getting. It's a little bit. There's a little bit of profit left. But go back to cost of goods sold for 30% and the cost of labor at 30%. If we were at 65%, if we added another 3% to cost of goods sold and 2% to labor, then we're shrinking all the way, and we've got to move all those other pizza slices. Then our profit is the last one to get impacted. Our profit will suffer. Our profit will shrink. We'll get less pizza in the profit segment if we have any more in any of those expense categories. The two biggest expense categories, cost of goods and cost of labor, we got to control all of them, but they're the biggest. Right here, they're the biggest. They need our super attention. And if we take away, watch what happens to the star at the top. We take that away. We're taking away our profit if we keep increasing our expenses. We don't control them. So prime cost, cost of goods sold, labor cost, no more than 65% as a target. And then that's the importance about prime costs. And we were talking about prime costs because we're talking about controlling costs. Little sidebar in our journey when we're talking about revenue and profit, and we're talking about expenses and costs, right? So cost control, effectively managing costs, can mean the difference between keeping a business live is sending it broke. And it's called cost control because somebody's got to be in control. Somebody's got to be holding onto the rope. It's not called costs will figure themselves out. It's called cost control. And if we don't have controls, then we don't have no way to figure out performance goals and no way to manage anything. And we don't have an impact on profitability goals. So it all starts with cost control. Cost control, control your costs. Now, our conversation, this exploration is revenue and profit and the different profit money bags. And let's bring it back full circle. We were talking about operating profit. Now, as to summarize operating profit, if we took this big old sidestep and we were looking at costs and cost control and prime costs. Operating profit's what's left after also paying for operating expenses. All those operating expenses come out to get us to this operating profit. Operating profit, the expenses that need to be made in order to do business, and the fishing net, the net. If there's holes in our net, we're going to leak out more expenses. There can't be holes in our net. We've got to control those expenses, those operating expenses that we have to pay to do business. We have to control them. If we have a tight net, we can control the expenses. If there's a hole in the net, we're in trouble. So operating profit. Now, remember that the cost of goods sold was already subtracted into that first, from revenue, into that first money bag of gross profit. And then from there, we took away all our operating expenses to end up here in operating profit. Operating profit is the middle pot, the middle bag, with revenue, of course, on the left being a revenue. It's not profit. So gross profit shrunk us down to operating profit. There's still more to come out. Someone else wants a piece of our money. Someone else wants a piece of our money, and they want a piece of our money in the form of taxes. So after we've taken away all our operating profit, then we've got to pay taxes. And after we pay taxes, we're down to the last money bag, the last money pot, which is called net profit. Now, I gave you an analogy of a net, meaning when we're controlling expenses, we need not to have holes in our net, meaning we need to be controlling and containing our expenses. This last one is called net profit. Net profit shows what a company makes after deducting all costs and paying for all taxes. So net profit, the net profit result after we've paid for all our expenses and paid for all our taxes, that net profit could hopefully, please, be a positive balance, meaning the business actually generated a profit, or the outcome could be a negative balance, meaning we generated a loss. So if what's left in that last part is a positive number, we made some profit in the business. If what's left in that last profit profit bag is a negative number, then the business lost money. Right? Think about that. Now, if we've got a positive net profit left over in the business, what do we do with it? Well, the business owner could say, hey, I want that. Pay me a cash payment out of the business in the form of what's called a dividend. So net profit, we could take that net profit because we've already paid our expenses. That's money that's left. A dividend could be paid out to the owner, a cash payment. We would need to have a journal entry that would transact and record that so we knew where the money went. Or if we've got a positive net profit, money could be transferred, kept in the business, and transferred into a business equity account called retained earnings. And retained earnings means we retain that money. Those earnings, we retain it and we're keeping it in the business. We invest that money back into the business. Now, retained earnings is important because when we get to financial statements, there's one of those financial statements is called a statement of retained earnings. That's going to come back full circle. We're not there just yet. But the notion of retained earnings, net profit positive, paid out in a dividend to the owner, create a journal entry. Net profit positive, transfer it to retained earnings with a journal entry, and we keep it in the business. Reinvest it, buy new things for the business with those retained earnings. So this net profit is our bottom, also called the bottom line. It's the bottom. We're at the bottom of the scale down. Now, the bottom line refers to the last line on a company's income statement. The bottom line, it makes sense. The bottom line is a company's net income after all expenses have been deducted from revenues, the bottom line. So back to this financial statement, it's an income statement. What's the bottom line called? Sure, it's called profit in this example, but that's not accurate. We know the bottom line is called net profit. And we had to go through a lot of different profit money bags in order to get to that bottom line called net profit. So holistically, look what just happened. We had a watering can, which was growing our business. That was our revenue coming into the revenue money bag. And then costs of goods sold came out after revenue, and we got to gross profit. From gross profit, our operating expenses came out, and they're the ones we have a net around. We need to control and contain the costs of doing business. And after they came out, we landed on operating profit. After we got to operating profit, we had to pay some taxes. After we paid our taxes, we ended up with net profit. Net profit is our bottom line in the income statement. And our journey continues in our accounting cycle where we've done our journaling and transactions, and we've done the general ledger and the adjusted trial balance, and we've posted adjusting entries, and we've got an adjusted trial balance. Our next task is we get to create those financial statements using all the knowledge that we have to this point. So objective here, understand revenue and profit and costs and how they shrink and all they go in together. Target met, objective met, end of video.